So today we're talking about Michael Burry, AKA the bear market prophet, AKA the bubble buster, AKA Cassandra. That nickname comes from Warren Buffett. He's back and he's louder than ever. If you're not familiar with Michael Burry, he predicted the 2008 market crash. Not only did he predict it, he put a lot of money into shorting the companies responsible for the 2008 market crash, and he cashed out big time. If you're not familiar with the 2008 market crash, TLDR, doing a real simple summary, banks were lending out mortgages to people that couldn't afford them. When it was time for the people to pay back on these mortgages, they couldn't, so the banks had to default on loans. Now, there was a complicated scheme because these were called subprime mortgages, and they were passing this money around to each other, and it was like musical chairs of debt. And when the music stopped, whoever had the bag was stuck with the bill. Now, Michael Burry foresaw the 2008 market crash, cashed out big, and he's back in the news talking about the next bubble is here, and he's saying it's the AI bubble. Now, I don't think he's saying that AI is just a bust, but the companies that are supposed to be leading this movement, he's not too confident in them. And these companies, their stock prices are going up. So I want to pivot right quick to talk about PE ratios. PE ratio is the price to earnings ratio, and real simple. That is when a company, for every dollar in profit that they earn, investors are willing to put in X amount of dollars. So I was having a conversation with my dad, and he said back in the day, 80s, 90s, a good PE ratio would be 10. So for every company, for the earnings of the company, if they earned $1 in profit, investors were willing to put in $10. So we take a company like NVIDIA, who has a 3-year average PE ratio of 77. Every dollar that the company made in earnings, investors were willing to put in $77. And here's the thing, NVIDIA is not just making $1 million in earnings. No, they're making tens, hundreds of millions of dollars in earnings. So now I'm bringing up PE ratios because I think it's a good indicator of people's belief, right? You see the company's earning this amount of money, and you believe that they have the potential to take the extra capital and earn even more money, okay? Now, going back to Michael Burry is saying that, you know, it doesn't necessarily make sense. Now, we know it makes money, but he's saying it might not necessarily make sense. Now let's bring up the 2008 housing crisis. Those subprime mortgages didn't necessarily make sense, but people will find a way to make it make sense so they can justify their earnings, the money that they can make off of this thing. So the belief thing is, maybe the belief is that you are genuinely optimistic about these companies leading the AI future. Or the belief could be rooted in, I want to maximize my returns. I don't necessarily care if it makes sense. Does it make money? And then, if we're going to be plain about it, if your source of belief is more the latter, then really, we could say that's rooted in greed. Because now you're bypassing logic. You just want to make money. And if you're not careful, when the music stops, you might get held holding the bag. And I'm going to throw out another thing. The United States, the current administration, wants the Federal Reserve to reduce interest rates. And when we think about interest rates, that is just the price of the loan, and arguably we could say the value of money. So as interest rate goes down, the money becomes less valuable. Another way to look at it is money becomes cheaper to borrow because interest is just the price of the loan. And so it's to incentivize a structure where institutions and even individuals can borrow money at a lower price to invest in the markets to make more money in returns. And now let's think about your money. You have your money in a bank, and it's not making a ton of interest. And as interest rates get lower, the money you have in the bank, the interest that you will be making on that money will be even lower. So outside of having your emergency fund established, which we would say put in a high yield savings account, maybe at 3-point-something% APR, after you have your emergency fund established, 3 to 6 months of all your living expenses, then put every single dollar beyond that towards investments, assuming you have a debt repayment plan. Put every single dollar beyond that towards investments, because you'll make more money compounded over time in the markets than what you would make just by saving the money. So we can see where, going back to the PE ratio, some of these companies might not make sense, but what are your earning potential? And if you prioritize that too much, you might get stuck holding the bag. Now, despite booms and busts in the economy, very fundamental thing is if you dollar cost average into an index fund and you're doing this, you're really investing. So you're thinking in 10-year increments and you just dollar cost average, maybe every month, fixed amount into an index fund, compounded over time, time being 10, 20, 30 years, then your earnings will be good. Because the way these index funds work, they go up, they go down, but higher lows and higher highs. Now, when you're trying to maximize your returns and you start going into the individual companies, now you're taking on more risk. And that's where you'll be a bit more sensitive to boom and bust cycles in the markets. So, do you think Michael Burry's onto something? Do you think he's just coming around with more doomsday advice? Are you just focused on index, dollar cost averaging and index funds, and whatever happens, happens, who cares? Or are you taking a little bit more risk, still doing the index funds, but maybe going into some individual companies and just trying to maximize your returns? And are you seeing like, he might be onto something, I might want to reallocate my portfolio, or you're like, this guy, it's just yapping. He got one thing right. What are your thoughts? I'd be glad to hear them. See you next time.